folks. We on? G'day, everyone. How you doing? Let's start by giving another big round of applause to the organisers. It's a massive thing to put this, something like this on. A huge round of applause. That's the end of my pre-prepared speech. So mine's called There Is No Second Best. This is a term that I'd like to coin. There's some other bloke called Michael who's been trying to popularise it, but not many people have heard of him. So what I wanted to open today with is just to give everyone a sense of really two things. How big Bitcoin is, which is a marvel to itself. So just understanding some of the numbers that we're dealing with as a multi-trillion-dollar asset. But then also getting a bit of a grounding, because that at the same time, you've got to realize a big thing takes a lot of inertia and a lot of work to move it. So it certainly helps me just understand how big it is and therefore how much force we've got to put on, demand or supply, to push it around. So we'll talk about the sense of scale. I want to talk about how Bitcoin is the biggest fish in its pond with no equal, and it's quite measurably so. Talk about how it's also the smallest fish in the biggest pond that has ever been, which is financial markets, right? The size of Bitcoin is massive to us, but it's insignificant compared to the rest of the world. We'll talk about the ETFs and the institutional demand, which is both simultaneously massive and insignificant, and the immense sell-side pressure that we've absorbed this cycle, which may sound kind of bearish, but when you think about that every seller has a buyer, we're also describing how much money has come into this asset. I think some of the numbers will be quite impressive. No, lost my clicker, guys. There we go. So, sorry, I got to go back one. I wanted to open with this just to give a bit of a sense of scale. So what we're looking at here is the top 6 coins on CoinMarketCap. 2 of them happen to be fiat, so we can probably remove those. If you take the supply of Bitcoin that has not been mined, it is the 4th biggest coin. With Tether, if you kind of remove that, 4th biggest coin. So it gives you a bit of a sense of scale that just the coins that aren't there yet are bigger than everything else that is, right? So it kind of gives you a bit of a sense of scale. That's $100 billion worth of value at today's prices, just as a bit of a round number. And also just to get your head around things, 100 billion, if you were to stack 100 billion 10-cent coins, you'd get to the moon and back 3 times, right? Gives you a bit of a sense of scale of how big 100 billion actually is. So this is looking at the market cap of Bitcoin. So we hit $2.1 trillion in this cycle. The sad-looking purple thing down there, that's Ethereum, number 2. And then the green line that's barely distinguishable from the 0 line, that's Solana. So we are now 6 times larger than the second biggest thing. And that's a $1.6 trillion gap. And if you were to subtract any of these coins' market caps from Bitcoin's market cap, it kind of looks like Bitcoin's market cap because it just keeps going and getting much, much bigger compared to them. And this ratio is actually getting larger and larger this cycle in particular. The orange trace there is Bitcoin's intraday market cap swings, how much the market cap moves between the high and the low. So this is just daily chop, daily noise, irrelevant price action. That green line behind it is Solana's entire market cap. So Bitcoin just moves on a day-to-day basis, doesn't really go anywhere, and it's still moving an entire Solana. And you can see that Ethereum up there, we're now moving about 20% of Ethereum's market cap in a single day, just ad hoc movements. 100 to $200 billion price swings. For a sense of scale, CBA, our biggest bank, is 160 billion, so we move one Combank every single day. Uber's 150, and BlackRock is 150 billion. So it kind of gives you a bit of a sense of scale of just how large Bitcoin actually is. If you were to DCA, and let's just imagine Bitcoin's price remains the same, and you start DCAing, you buy $1 of Bitcoin every single day, price remains the same, it's going to take you 64,000 years to accumulate the whole market cap. So it's, 2 trillion is a very, very big number. We move 100% of a Solana every single day. We used to move 5% of an Ethereum. We now move 20%. So that divergence is getting larger. Bitcoin is getting bigger relative to its competitors, not smaller, right? And this is something that is widening in this particular cycle, as we all know, by Bitcoin dominance growing. Now, that's enough about shitcoins because they are indeed irrelevant. What I do want to talk about is how big Bitcoin is compared to us, right? $2 trillion. It's a massive number, 64,000 years at $1 a day, $1 a second. But if you look at the global world of finance, it's insignificant, right? At the nearest, really, where we're going after first stop, digital gold, going after gold is something in the order of 20 trillion. But then we start talking about hundreds of trillions and up to 620 trillion in terms of real estate, which is the biggest asset class in the world. So whilst Bitcoin is enormous relative to anything we can imagine, it is so small by compared to everything else that's out there. Now, the ETFs have been a massive change this cycle. They're not strictly different because we've always had these demand sinks, whether it's exchanges or GBTC or whatever it is, but they've hit $100 to $120 billion. Again, this is like almost an entire Combank in 1 year of value flowing into these ETFs. And if we were actually to plot that out as in terms of market cap rankings of companies, the ETFs would be the 130th biggest company in the world after 1 year. Now, the AUM obviously depends on the coin price. If you buy Bitcoin, as we know, number go up technology, it becomes worth more over time. But how much money has actually flowed in, initial purchases of these ETFs? If we just take IBIT and FBTC, the two big ones, that's 50 billion, which is as large as Wesfarmers, BMW, or LG. So again, just the demand, this is the dollars going into these ETFs, just two of them, is as big as some of the biggest companies in the world. So the chart on the left is Bitcoin's AUM for all of the ETFs. The yellow one, which took over 20 years to get there, is GLD. That's the biggest gold ETF. So they've got 82 billion. It took them 20 years to do it. We got 100 billion after 1 year. So the sense of scale of how much money is actually coming into Bitcoin relative to its size is actually quite extraordinary. So it really does explain how the market has traded the way it has this cycle. Because we've just had tremendous amount of demand, tremendous amounts of value flowing into something that does have a fixed and scarce supply. Now, it's not a perfect model, but I was trying, we all know that gold is less scarce than Bitcoin, so I tried to work out, well, how many kilos of gold is equivalent to 1 BTC, and try to just do some numbers to work out what is an equivalent, if we allow the Bitcoin ETFs to follow gold, where could we potentially get after a period of time? So on that equivalent basis, and this is looking at gold in terms of kilograms, not ounces, so I had to actually amp everything up by 1,000x just to make it work, we get to 4.2 million Bitcoin that may or may not flow into these ETFs. In terms of just like a relative demand, if the Bitcoin ETFs were to follow GLD, this is the kind of magnitude that we're getting to. So we're going up from 1.1 million up to 4.2 million. Right? So it's not a perfect number, but it gives you a bit of a sense of scale of how big that gold bull run was, being a much, much larger, much, much older asset. If Bitcoin is to follow even a fraction of the trajectory, it's a lot. Now, of these ETFs, it's not a perfect number again, but about 20% of the ETFs are held by institutions that have more than $100 million. So these institutions have to file what they call 13Fs. So from this, we can essentially extract what's their AUM for the actual company itself, so what's their overall holdings, and then how much of that is the Bitcoin ETFs. So I ran a study just looking at what's the typical amount, how much are these institutions investing, and I wrote a piece called Dipping the Toe, and James Lavish talks about this. The concept of dipping a toe is that institutions, they just put a little position on where they don't actually care. They don't really care. It's so small that if it goes to zero, it doesn't bother them. But they just put a small test position on to see how it trades, get a bit of a feel for it. Now, the bottom axis there, don't worry too much about it, but that's in log scale. It's the size of the company. So the further towards that red box they are, the bigger the company is. And we're talking about upwards of trillions of dollars on the far side. And then the blue boxes, these are small companies, hedge funds, small money managers, family offices, entities that are big enough to have to file a 13F, but also not the BlackRocks of the world. So the small firms have, generally speaking, 1 to 5% allocation to the Bitcoin ETF. There's some who have 100% because they're just an all-in Bitcoin hedge fund. But if you start moving to the other side and you start looking at how big their allocations are, these are trillion-dollar firms who are allocating 0.01%, and that's $100 million. Right? So 100 million is 0.01% of their portfolio value. They haven't even dipped a toe. They've dipped the smallest hair on the smallest, hairiest toe that they have. They're just getting the first feel for what this thing is. And you start to think about, well, what happens if they increase their allocation from 0.01% to 0.02 or 0.1 or 1%, right? These numbers just become absolutely gargantuan. So I ran the numbers, and I had to take off the top ones where they allocate 2% and 5% allocation because the scale looks just ridiculous. But if they were to all allocate 0.5%, that's going to bring in another $68 billion. Remember, the ETFs have taken in $50 billion so far, so double your ETFs and some. If they were to allocate 1%, that's a 550% increase in their current holdings, and there'll be $136 billion. So, and again, who's going to care about a 1% position? These institutions aren't going to care about a 1% position. They've got a 0.1 to just test this thing out, 0.01. So it gives you a bit of a sense of scale of just how big the pond that Bitcoin has just swam into really is. So pulling it back to, this is, I think, the most important metric that I use. It's the backbone of everything we do in on-chain data. It's called the realized cap, and I'll just describe what it is because it's really important. And whenever someone asks me, is Bitcoin seeing adoption? This is the chart, this is the data that I'll look at. The market cap just takes every coin in the supply, multiplies by the price. Now, the problem is that not every coin is moving, not every coin transacts. It's not really a very good measure. The realized cap values every coin at the price when it last moved on-chain. So if you bought a Bitcoin at $10,000 and you've just hodled it ever since, it's saved at that $10,000 price. So in a way, it represents how much money you invested in Bitcoin. You buy it at 10K, you sell it at 100K, someone else has got to come in with that $90,000 delta to take it off your hands. That's a capital inflow. That poor guy's probably going to buy the top, he's going to sell it at a lower price, that's a capital outflow. So the realized cap shows us how much real money has come and gone, won and lost. It's the aggregate value that people have saved in Bitcoin. So since FTX blew up, so since 2023, we've had $500 billion, $500 billion in measurable capital has flowed into this asset, $500 billion. Now this isn't like, $500 billion of AUM because the price went up. This is $500 billion of people who bought coins at a higher price from when they were first acquired by the original buyer. So as coins change hands, $500 billion worth of value, which is an extraordinary number. And again, if we're talking about $1 trillion is $1 every second for 64,000 years, this is the kind of magnitude that we're talking about. So there's a few different ways I can measure demand and how much capital is actually flowing into Bitcoin. Again, there's no perfect models, but we just want to get a bit of a sense of how the demand is flowing in. So what I've done with this chart, I've anchored everything to the 1st of January 2020, because I think for most people, when we think about inflation and we think about how the world has changed, go back to the 1st of January 2020, that was a bit of a pivot point for everybody. So the market cap of that 2.1 trillion, 1.94 trillion has happened since 2020. So in other words, the rest of Bitcoin's history is kind of irrelevant by comparison to the move we've had over the last 5 years. As another fun fact, last week, the weekly price candle was $18,500. And the all-time high in 2017 was $19,000. So we did an entire zero genesis to 2017 in 1 week, and everyone's just like, another day in Bitcoin, right? It's just another day. All the profit and loss, so we don't care about if you destroyed capital, if you bought the top and sold low, or if you bought high and sold, we don't care about any of that. Just sum together all the changes in how much coins have been revalued. If you buy at 10K, sell at 100K, that's an additional 90K. If you buy at 90K and sell at 80K, that's an additional 10K, because someone's still going to buy that coin off you. So the green line is the total amount of profit and loss. We're not subtracting them against each other. So you can really think about this as like true demand. Someone had to bring that capital to the table. $1.3 trillion since 2020. The realized cap, which then takes losses away from profits, so it's probably more of an accurate read, 740 billion. And the ETFs, this is why I would challenge a lot of people who say that the ETFs are the only driving force of the market. You've got to kind of squint to see the little ETFs down there, right? Very important, not the most important. By my calcs, the ETFs are something like 20% of the market demand. So there's another 80% that's just the Bitcoin market that's existed before the ETFs, which, surprise, surprise. This has been my favorite statistic of late, which is, this is looking at where all the dollars have been invested. So the x-axis is the price, and the bars, or the height of the bars, is how much dollars has been invested in Bitcoin. If you can believe it, more than half of all dollars that have ever gone into Bitcoin have a cost basis above 85K. Now, that should be both equally terrifying and awesome, because terrifying in the sense that those people are all probably a bit sensitive right now, given that the price is below their cost basis. But think about how much money has come in and being willing to buy Bitcoin at 90 and 80 and 100K, right? This is serious money coming in to keep us up at these levels. Now, I just want to transition across and have a look at the sell-side pressure, because sell-side pressure is it's a forbidden topic in Bitcoin. People don't like to talk about it. This is the price suppression that everyone doesn't want to talk about. This is long-term holder supply. People have held their coins for 6 months. The amount of debates I have that 6 months isn't long enough, it doesn't really matter, because at the end of the day, one person selling one Bitcoin is equal to one other person selling one Bitcoin. Irrespective of how long they've held it for, we can measure it 500 different ways. If we look at 2017, that was by far the biggest bull market that Bitcoin has ever experienced across pretty much any metric. We never really got to the same peaks in any metric until this cycle. So we had 3.1 million Bitcoin change hands in that 2017 period. So if you think about this, as the market's rallying, people who've bought their coins at a cheaper price, they're selling, they might buy those coins back and then trade it again, it doesn't matter. Those coins are just changing hands. Someone has to come in and buy that supply. So whilst a lot of people don't want to talk about sell side, I love to talk about sell side because it actually tells me about demand. It is the actual measure, it's the only way we can really measure demand is how many coins were distributed and where's the price going after that. Because if people keep selling and the price keeps going up, you've got rip-roaring demand. So in this cycle, we've had 2 waves. And in total, 3.25 million Bitcoin have changed hands, which is now the largest. So quite remarkable. And yet we've barely had a 25% correction. Is about as bad as it's get. We got one for 30% that lasted 4 hours. These are waves of that sell side. So this is looking at our current market cycle. In the ETF rally, we had $150 billion of just long-term holders. Then usually long-term holders are about half the sell side. People who bought more recently and they're kind of swing trading and all the rest of it, they'll usually represent the other half of it. So if you just roughly double that number, we had about $300 billion of capital flow in. 2 CBAs worth of actual measurable value came in just on that ETF rally. We chopped around, and here's another fun fact. About 50,000 is about our $1 trillion level. For a market cap for Bitcoin. 60,000 is about 1.2 trillion, 70,000 is about 1.4. In 2021, we tried to get above $1 trillion market cap twice. The first one in April, and we got 50%ed overnight. And then we tried it again in November, and then we had a horrendous bear market that took us down to 15K. We then spent 8 months last year, 8 months. Every single time we went down to $1 trillion market cap of 1.2, it was pushed right back up very, very quickly. When the German government sold their coins, they sold 58,000 Bitcoin over the span of a month. Here's how price and markets work. They sold the first 10,000. There was a 1-month program. In the first 3 weeks, they sold 10,000 out of 50, and the market tanked from 63 down to 53. They then sold 38,000 Bitcoin in a week, and the market went up through it. Because this is how markets price things in advance. All the traders go, oh shit, it's all coming. They sell the market down, and then the smart money goes, thank you very much, German government, sell me all the coins you can, and they push the market higher. So you've got to kind of think about sell side pressure as an inverse. It's both demand, it's telling you a story about how much we can absorb, but also, if you've got these large sellers, institutions, these people who are filing these 13Fs, they know how markets work. They know markets don't go up forever. They will allow the market to come to them. So when the market goes down, these institutions are now saying, thank you very much, I'll take those coins off your hands. Now, in the second wave that we had up to 100K, it was almost $200 billion of sell pressure. And yet we're still chopping around. We're crashing to $85,000. So this is the drawdown profile that we've had since what we're looking at is only an uptrend. So this is not the drawdown since the all-time high. This is the drawdown that we've had since the cyclical high. And if you can look at the general profile, it looks quite similar to our 16-17 market structure, right? Where we get back then we were getting regular 30% corrections. Right now we had one 30% correction that lasted 4 hours. Most of the time we get like a 15 or a 16% correction. Right now we've had a 20%. So, you know, the just general scale of how much the market is pulling back, given $200 billion worth of sell side, $80 billion a month, the fact that we haven't pulled back to this extent, it tells you a story about those institutions and the size of the money that is actually coming into this space. So second last one, and I'll have some time so we can do some questions at the end. This price structure, to me, and I bought the 2017 top. That was my claim to fame. I bought the absolute peak. Coinbase had an extra fee, so my top buy is above the top wick. You couldn't have bought higher than me if you tried. Thank you, Alec, for the recommendation. So I've never really lived, 2021, it was a weird bull because it just teleported upwards, right? We had 660,000 Bitcoin bid coming from GBTC. So a lot of people look at, that 2021 cycle was very interesting because people blame the China mining ban for why we went down. My general view is that we had GBTC on the bid, 660,000 Bitcoin for 4 months. The moment that flipped into a discount, the market just lost all structure. So Lynn Alden said this once, and I wish I kept the tweet. She was basically saying they just went too hard, too fast, and then we had to correct back to that baseline. And I actually agree with that framework. I think the market in 2021 was very unstable, very leverage-driven, not sustainable. This is sustainable. Upwards, sideways, upwards, sideways. In market speak, this is what we call quiet and trending. So quiet and trending literally is just it goes up, it goes sideways, it goes up, it goes sideways, because we're getting these periods of consolidation. And each one of these periods of consolidation, we're coming down testing the highs of the previous consolidation, which we're in the process of doing at the moment. This is very, 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 very normal, right? This is also very, very stable. This is how a market continues to climb higher and higher. This is not euphoric. This is not, you get phases, periods where it's a bit frothy, but this kind of price structure is extremely constructive from my view. I don't know about you guys, but I can't envision 80% down to 20K. I think there's going to be too much money that steps in front of that. So if we just think about how this market is trading, there's a lot of doom and gloom out there on very small price moves. There's a lot of reasons for that, but one of them is I think people are not used to the smaller percent, bigger dollar. So when you go down 10% now, it could be 10 grand, right? Whatever your portfolio is, you're seeing a very large dollar number change, even though the percentage is smaller. But this works in the other side as well. To get to 150K, we need an additional $1 trillion to come into the market cap. Now, it's not to say it won't happen. We've seen some of the numbers. But you probably need something in the order of about 200 billion in capital to come in for that to happen. So what does 200 billion look like? Well, the ETFs, if they're 20% of the overall demand, you probably need the ETFs to almost double in size to get up to that kind of level. Now, the other thing to remember is that those green boxes do not happen without the orange boxes, and vice versa. You need to have the orange box where the market chops around, redistributes, refines its equilibrium level in order to get the green. If you just get one big green like we did in 2021, you're going to get a very large red off the backside of it. So generally speaking, this is very, very healthy market structure. And even though Bitcoin is a $2 trillion asset now, it is still moving just like it did back in 2017. So at this size and with these hundreds of billions of dollars and market cap swing as much as Australia's biggest bank, we're still grinding higher like we did in the spot-driven market in 2016 and 17. Now, I hate the right-hand side of this chart. I love the left-hand side of this chart, and I'll explain why. The right-hand side of the chart is where the moon boys live, right? Because they expect 100x returns, they think it's going to follow. It's not going to happen that way. The left-hand side is much more useful because markets are all about psychology. And the bear market, if anyone, who was around for the 2022 bear market? Yeah, survivors. So that process takes time to recover from. There's a PTSD element that we all experience. That every next red candle, you're like, it's just another lower high, and the ghost of Sam Bankman-Fried's coming back, and like all this stuff. This is natural human psychology, but it takes time for us to go, I actually trust this now. I get it. And even though hodlers, we stack all through it, you eventually reach this point of like, okay, maybe this rally is going to stick. And it's interesting because that's usually the time when people start saying, hey, the bull market hasn't started yet. It's probably in the last 10% of the bull, right? That's usually when people become so confident that the bull market is just getting started. It's pretty close to being at the end. So I like the left-hand side because it tells a story of that recovery process. The last two cycles have followed almost the exact same pattern with, there's obviously nuances in between each one. But folks are just strangely bearish considering we're crashing at 85K, we're having hundreds of billions of dollars of demand, the market's barely pulled back 20%, and we're following a 2017 footprint. So it's important to remember that Bitcoin is a multi-trillion-dollar asset. That alone is a remarkable feat. It's very big. It's much bigger than we can really fathom. These numbers of trillions, they throw around trillions in the deficit like it's just nothing. It's like when you actually think about it, it's tremendous amounts of money. And yet the market cap moves. It moves as much as big companies. The 150th biggest company is just Bitcoin's latest daily move. We're moving $18,000 candles these days. But over $500 billion in measurable capital has come in since 2023. $500 billion, which is an incredible stat. And the institutions have really only dipped the smallest hair of their smallest toe. And they are getting comfortable with it. And this is the thing that I think a lot of people missed with the, I don't particularly care about whether the US government buys with this strategic reserve. What actually matters is that they just gave a green light to the most conservative institutions in the world to say, hey, that 0.01% you've got, you're safe to increase that to 0.02. So to me, that's the actual signal here. Who cares if the government buys? I think too many people have focused on that side of it. Why is the government going to be able to put in more of a bid than the biggest institutions who have more money than God? Right? So these are the entities who are really, we need that style of capital. Retail simply can't get us to $5 trillion, $10 trillion. As a example to this, gold, was a $12 trillion asset just a year ago. It added $6 trillion to its market cap. So once sound money gets moving, it usually gets really moving. So these things, once they do get a structural bid under them, keep the moon boy math, it's a possibility, but also just frame it up in terms of it's going to take a lot of work. It's going to take a lot of time. It's going to be a grind. But it's the best kind of grind because it just goes up and sideways, up and sideways. Eventually, we will break that structure, but just keep in mind that these things are going to be slower. The moon math will happen, just not on the Moon Boys timeline. So there really is no second best, and when you compare it to just about any other, I think the distinction also between Bitcoin and crypto is now very clear. I actually thought this was going to take many more cycles. Back in my time at Glassnode, talking to institutions, they were just dipping their toe, and they're like, oh, I want to build a diversified portfolio. I've been very, very surprised at how quickly they've all collapsed to realizing that there really is just one signal in this whole space, and it's actually now codified in a law somewhere. So it's a very, very interesting dynamic. But we're very early in this for institutions. We're not early for retail, but we are definitely at the earliest phase of institutions getting into this thing. The numbers they move around, we actually just can't fathom. So yeah, there is no second best, and send Michael my regards. I can do questions. Need time back? I can do some questions.
Yeah.
I've got 3 minutes. Are there any questions that we can do just to open things up? Anything's free. First country to print and buy, I don't know. The problem with this, and that's what I find so difficult about this current environment, is it's political, and you can't predict any of that stuff, right? No one can predict markets, let alone what politics are going to do. I don't know, but personally, I think if you just think about it from a core perspective, printing money to buy anything is quite immoral. So I would hope that whichever country does it, you kind of expect them to print money anyway. I really don't hope it's going to be a G7, because just think about the signal that sends to their population. We actually don't care about you at all. So I kind of hope that they don't. Absolutely. The ETFs, totally. So here's the number one risk. I see this all the time. Coinbase doesn't have the coins and the ETFs aren't backed. That ain't the risk. The risk is that they are so backed, and they have Coinbase has 3 million coins. That's the problem. The problem is actually that they have way too many, not that they don't have them. Yes, so that's a very good question, and this is the last one. In the first rally that we had in March when the ETFs went live, a lot of those coins were people who've held for many years, people who finally got their sizable enough buy that they can exit in a meaningful chunk. This time, in the 100K rally, 70% of the coins that were sold were people who bought in that 2024 chop-solidation range. So we've actually, and interestingly, if you look at the way that those coins have been accumulated, we don't have a stack of people who bought at 100 and 105 and 108. Most people bought at 90. So we've actually got, even though we've got people who are almost swing trading and selling up to that next level, it's kind of like a redeposition of coins to a higher price. Even though we've got that behavior, most of the people who are buying are waiting for the market to come to them and buying at 90 and 95 and now 85. They're not moonboying it and buying at 105. So that, again, there's just so many signals that tell me it's a more sophisticated environment. The drawdown profile, I was looking at that in 2023 thinking something is different this cycle, and it's about the buyers. There's always going to be sellers, but the buyers are more sophisticated, more patient, and more serious. So that's it for me. Thanks, folks.